you.
Good afternoon. This is a really important topic, and I think we all know that we need a long-term lens. So we all know markets are volatile, geopolitics fragmented, and climate risk increasingly material. Yet resilience requires patient, long capital. What has fundamentally changed in how serious investors think about long-term risk and returns today? Your Excellency, what's your perspective?
Thank you for asking, and good afternoon, and hopefully better New Year for everybody. In my view, the one single trend and issue which is defining long-term development is the energy transformation, related, of course, to climate change. Despite the denials in some even important jurisdictions, climate change is a reality, and in my view, the large majority of governments and investor communities have realized this, and this is going to be the defining feature, defining trend in our time. And I might add one point, which is that in some countries, like in Europe, in Northern Europe, we have already seen a very significant turning point in a sense that the setting of market price in the electricity market, like in the Nordic electricity market, is no more fossil fuels, it is wind power. In Finland, my native country, for instance, over 90% of electricity is produced by fossil-free fuels, 40% nuclear, over 50% renewables. And this is one reason why we have relatively inexpensive electricity, and one reason why Finland is an attractive destination for data center investments. So it's the energy transformation that is defining our time.
Thank you. I hope that's on. All right. Sarah, would you like to add something to this?
Yeah, adding to that, I would say there's been this big shift in the last year and a half of, particularly on long-term investors, on realizing the importance of national security issues that may not have made pure financial sense in the short term, but these long-term national security goals that will pressure and put pressure towards things that will lead to returns, but also are affecting the strategies in ways that they didn't in previous years. And this is really acute in North America and Europe, I would say. I think this region is much more aware of those things, but it's very much shifted in North America and Europe. The other piece is that on a long-term basis, particularly for investors with 10-year beyond horizons, they're starting to integrate what does physical risk of climate look like and how to think about it. And they're trying to think about not only how will it change consumer behavior, how will it change the pricing of assets, but also when is that going to happen? Is that going to happen 10 or 20 years from now? Is that going to happen when science evolves and we learn new things in the next decade? Or is it going to happen in the next couple of years because of what's happening in insurance markets? And so there's this thinking through what does the world look like, and then when do people in the markets respond to it that is taking place?
So Hui-Fong, from an Asian perspective, long-term risk and returns, what do you see in this area?
Thanks, Nadia. Against today's backdrop of volatility and fragmentation, I believe investors have fundamentally changed how they view long-term risk. Environmental, social, geopolitical factors that were used to be viewed as externalities, they're now widely considered and recognized as core and mature drivers for long-term risk and return. And investors are increasingly focused on how climate risks affect the asset valuation over time, alongside a growing recognition that social cohesion, stable governance, these are also prerequisites for sustainable returns. And in this context, I do believe the multilateral development banks like the AIIB are positioned uniquely to play a crucial role. The MDBs can connect geographies and economies and bridge the financing gap, and they do it by de-risking projects and setting credible investment standards. The MDBs can also lead by example in their own climate finance. They make sure their own portfolios are aligned with low carbon development pathway, and then they can help mainstream this approach across the financial system. So we are talking, working as a system together. MDBs can attract and mobilize private investments and making them a very important enabler of resilience in an increasingly volatile global environment.
Yeah, that makes a lot of sense. Sangyo, from your perspective,
Yeah.
you know, looking at long-term horizons, risk, returns.
Yeah, still many people regard climate crisis as a long-term risk. It is. But if you look at the other side, it is coming to us as adjusted returns. Let me quote two reports, one by IEA, International Energy Agency, and Patty Birol, who is the head of the IEA, is telling me that last year the world invested more than $2 trillion in green energy and climate tech, while the investment on fossil fuel remains $1 trillion. 10 years ago, $1 trillion. Last year, $1 trillion. But 10 years ago, the investment on green energy was $1 trillion. Last year, more than doubled. And he says the green investment contributed at least 10% of global economic growth. So it is coming to us as adjustable returns. And recent report by the Boston Consulting Group, along with the World Economic Forum, the so-called global green economy is now more than $5 trillion. And it would surpass 7 trillion by 2030. So no matter what is happening in the geopolitical stage, green economy is growing. And lastly, our organization, GGGI, Global Green Growth Institute, demonstrate more than 10% growth last year, despite all these things. So it is coming to us as returns. That's the point I like to make.
That's a very optimistic view and approach. I like that. So clearly substantial movement towards that.
Okay.
When we look at pricing systemic risks, how are interest rates and macroeconomic tools adapting to climate and transition risks? And which risks remain inadequately priced into the financial system? And what concerns you most for long-term stability?
Thank you. 2 points on that. First, there is clearly a mispricing of climate risk in the markets in our system, and that's why the leading economists of the world, over 3,000 some years back, including around 27, I think, Nobel laureates, called for a global carbon tax, which would be, from the economics point of view, the first best, most effective and efficient way forward. But as that is not possible in our messy real world, therefore we lean on and we count on binding international agreements like COP agreements, and in the case of Europe, the emission trading scheme, ETS, which is serving the same purpose as global carbon tax in the European context. In addition to that, both the European Central Bank and the European Investment Bank and other financial institutions in Europe are directing their work towards green transition and related technologies and investments. For instance, the Eurosystem and the European Central Bank, I'm sitting in the ECB Governing Council, we are the largest owner of green bonds in Europe. Second point concerning long-term stability. Price stability is of paramount importance, and what matters for price stability is central bank independence. To my regret, central bank independence is under threat now in the United States, and that's why yesterday a large number of international central bankers called for underlining the importance of central bank independence and defended in full solidarity Chair Jerome Powell of the Federal Reserve, underlining the fact that central bank independence is crucial for price stability, financial stability, economic stability, and thus it is essential for sustainable growth in the global context. These are, in my view, the current major challenges for long-term financial and economic stability.
Thank you. Thank you very much for sharing this. If we move towards climate risk and financial risk, where does scientific uncertainty no longer justify inaction, and where are investors most exposed if they delay decisions today?
Yeah, so based on the science, we now have enough climate change has now happened that fundamentally the statistics of what we're experiencing, the extreme weather events, the chronic changes, they're now fundamentally different than they were in the past. However, society, unless there's been adaptation, was built for a climate that no longer exists. And so where it's making companies start to respond and investors start to respond is when those changes are now starting to have financial impact. The first place that we're starting to see that really is happening in the insurance markets. We're starting to see the repricing due to past events of being larger and larger magnitude in terms of the events and the event frequency and now the financial costs. The other place where that's starting to happen is in credit markets, and it's in regions either where you have extreme risks, so it's parts of the world where you have wildfire risk, where you've now had the 10 worst wildfires in the last 5 years, or where you're having flooding events due to sea level rise in certain zones, or it's in locations where there isn't a capacity for adaptation, where the changes are happening rapidly and there isn't a way to respond, so you know the damages are also rising. And so you're starting to see that in certain corners of the world, certain types of industries that have these exposures that they can adapt rapidly. And so as that's starting to go into different sectors, different regions of the world, investors are now also starting to realize that they need to start planning for this. As our boards, I spend a lot of my time with boards talking about what their climate strategies need to be. And the big questions are, we know what the future looks like due to climate. There's some uncertainty, but we know directionally what's happening. We know the magnitudes of some things, and we need to plan for that. We need to start thinking about where do we want to be and what do we need to start planning and spending money for so we can deal with those problems in the future. But the big question always is, when does it start getting priced into markets, into financial capacity for financing, for insurance and everything else? Because that's when the movement in terms of companies and investors will really start to shift. And so it's this big question of, we know what's coming, we know that there might be pricing gaps, but we don't know when. And that's a human behavior question that I think that everyone in this room needs to have an opinion on as they plan for the future.
But the science is there, so...
The science is there.
Yeah.
We know, and it's one of the few things where we actually know what the future looks like. Okay. Nothing else in markets.
Yeah. Makes sense, yeah.
In science, we trust.
Yes.
Yes. Yeah.
It's a fuzzy crystal ball, but it's still a crystal ball.
Yeah. So, from an MDB perspective, mobilizing capital at scale needs to happen, right? So what structures are most effective to crowd in private capital? Because that's what's needed in the long term, right? And then for resilient infrastructure, and where does public capital still need to lead? Because there are still some areas where I think public capital is still taking the lead?
Thank you, Nadia. This is an important question. Because private capital mobilization is central to AIIB, we all know the infrastructure financing gap cannot be closed by public balance sheets alone. And there are major opportunities in attracting private investment to bridge the gaps. And in fact, today we know the private financing is still predominantly provided by banking sectors, with the large institutional investor pools remain untapped. So in AIIB, we set a corporate strategy with a clear ambition to reach 50% of private sector financing, including direct private capital mobilization by 2030. And it delivers this through a balanced model that spans both sovereign and private operations. And this combination, in fact, allows public capital to reduce risk upfront and public capital to scale solutions when projects become bankable. In terms of private capital mobilization, AIIB delivers this both directly and indirectly. Direct mobilization happens at project level, where we use loans, guarantees, co-financing to crowd in private investments because of the direct and active involvement of AIIB. On the other hand, indirect mobilization is happened through capital markets and financial intermediaries that help to expand the pool of investable infrastructure assets for institutional investors. Let me give you two real examples. In direct mobilization, AIIB extended a guarantee of 200 million for Turk Exim Bank's green lending program, enabling the bank to extend long-term financing for climate-aligned investments at a time of heightened market volatility. And by this targeted credit enhancement, AIIB helped unlock private bank liquidity, extend maturities, and lower financing costs. And this demonstrates how public capital can unlock private investments even under challenging market conditions. The second example I want to give is about indirect mobilization, and this is illustrated by Project Merlion in Singapore, where we partner with Bayfront Infrastructure Management to create a platform of investable infrastructure securities. And this platform refinances operational and cash-generating infrastructure assets, turning mature bank loans into investable, standardized securities. And this project helps free up bank balance sheets and crowd in institutional investors, long-term investors, and they help recycle capital into new, resilient infrastructure projects. So in essence, the ability to move from project anchoring to market building, I think is central to our catalytic role, and also to scaling private investments in climate resilient projects.
Yeah, I think we need more private capital to flow there as well. Yeah,
right.
Very good. It's good to know. Looking at policy making, Sang-Yup, how can policy making in emerging markets shape resilient investments to drive competitiveness and growth amid uncertainty, as we know, rather than being perceived as a cost or constraint? What future directions should governments prioritize to attract capital?
That is really wonderful question. Well, to boost up a long-term resilience investment and to encourage so-called patient capital work for the transition we need to have, investors need to be assured about predictability and calculability. And that's the role of government, to ensure that kind of the predictability and calculability. And for that, we need to redefine the notion of the game we are playing. It's not just about environmental policy. It is about industrial policy to upgrade your new national competitiveness. It is about technology policy to adopt innovative things. It is about new finance policy to make things be materialized. So in sum, it should be a national top priority, comprehensive, holistic strategy. That's what we need. And that's how we are working together with our member countries over the 50 countries around the world. Korea tried to have a new concept of climate policy under the name of green growth that was proclaimed in 2008. And China has been adopting green development policy since 2012 after President Xi Jinping took the power. It is all about industrial competitiveness. And that's how you invest money from investors. And that's what emerging countries need to have. That's how you encourage long-term investment in a much more workable. So we obviously need to enhance our climate ambition, but that could be alive when it could be translated into national strategy for new competitiveness. Europe is missing that part, to my eye. Europe has led the way for so many years. I admire those leaderships, but not just for regulation, but for investment. That's what we need to see in the world.
Thank you very much. Thank you all. I would love to continue this conversation. Unfortunately, we're out of time. Thank you all for your contributions. They were very insightful, and we'll clear the stage for the next panel. Thank you so much. Thank you.
Thank you, Nadia.